of the big areas that probably does not get enough attention is working capital management. And I think the importance of this, it's really about the efficient utilization of working capital, because it really does have a great impact on the profitability of your organization. I think skillful management of working capital is not difficult. It should take relatively little time and certainly should be considered in every company's planning consideration. One of the main companies that questions that comes up all the time is how much working capital I need, and you understand that working capital is really a ratio. You can take a look, current assets over current liabilities. Obviously, key to that is over 1-to-1. You want to have more working capital than you have obligations. Sometimes companies have working capital below 1-to-1 ratios, and that's when usually a third-party lending credit like the bank or the bonding company is going to ask ownership about injecting some new dollars into the organization to make sure working capital is solid. A couple areas to look at, obviously, invoicing is a big part of it. We've talked a little bit about could your terms change as far as down payments, collection terms, maybe even some of the companies go to the level of factoring it. Some organizations do not always have the best software in place to really take a look at managing the accounts receivable. You may be in an environment where you've got retainage going on. You're trying to track all of that. But I think it's very important that organizations invest in those kind of software and reporting systems that are going to help you identify just where the weaknesses are in your system. Obviously, for those of you who are involved in some kind of project management, you provide a service to a customer, you complete that service or that obligation that you have, you're trying to get collect on the billing, and you don't have all your documentation together. Cardinal sin, and certainly is going to impact any kind of working capital ratios. So, and I would just point that out because I think the management of working capital certainly should be definitely an incentive for you toward those people who are working in those responsibilities. A few terms that or a couple of tips that we take a look at is, and we talked about contract terms, electronic payments today can accelerate the cash receipts part of this process. I think most organizations have certainly tried to move toward that. I certainly do see more conversations. Even the dentist now, it's hard to get out of there without cash or check, credit card right there when that service is done. Obviously, there are opportunities to work on some installment plans, but electronic payments, hey, they're expecting it right now. Again, we should always be cognizant of discounts that are available and trying to take advantage of them. If you can move your cash operating cycle up 10 days, you should probably be in a pretty good situation to take advantage of some of those discounts. I did talk about the ABC vendors already, and I can't say enough about this area. I firmly believe that if those of you with that financial management responsibility took a look at all your vendors and stratified them, I think you would have an opportunity to improve your cash situation. Because usually what happens is that the individual may be assigned to cash. Probably if the phone is rang by company A 3 times, that's where the check is going. But if you've been up front with all your vendors and said, hey, you're a C vendor, you're going to get paid on 52 days, you can expect on 52 days. I can't believe an organization is not going to continue to work with you. Obviously, you know who your A vendors are and who need to be paid promptly and why, because of the discounts and the reputation, the credibility. But I really encourage you to take a look at this. I talked about managing fixed assets here as part of this working capital management too. Obviously today there's lots of different financing programs out there for on balance sheet versus off balance sheet. Obviously we have some accounting and tax compliance capitalization rules that we do have to follow, but today a lot of organizations are not investing in transportation equipment, as an example. They're going through and leasing them at the end of the lease, 3 years or 4 years. They turn it back over and get some new ones, and that's just part of their lease program, and they're very comfortable with it, improve their metrics because they're not reporting the debt on the financial statement or in a long-term line of credit. So again, very important that you have some kind of a model, a capital expenditure program that should be part of your cash flow budget, i.e. every year we invest, our max is $200,000, so every year we're going to input or acquire $200,000, and here's our model. If it's internal equipment, we're paying cash for it. If it's external and helping us generate revenue, like some big dump truck would, then we'll go 10% down. We're financing 90% over 5 years. So again, you have the responsibility to come up with a program in your own organization. A couple other areas to take a look at. Obviously, we talked about seasonal shortages, and maybe that should be where the line of credit is utilized. One of the real weaknesses I see is on the item number 3 here. People are buying a lot of short-term assets. It needs to be financed with short-term debt. Oftentimes we see long-term assets, all the capital expenditures in past years are financed with a line of credit. Makes it very difficult to put a good report card together with good ratios when you have this kind of a mismatch. Again, long-term assets are going to generate revenue over a longer period. They should be financed with long-term debt. Again, back to my model. 10% down, 90% financed 5 years. 20% down, 80% financed maybe 36 months or 60 months. But again, long-term assets need to be financed with long-term debt. Part of the planning process, you're always taking a look at that inventory levels. We've talked quite a bit about just-in-time inventory, this cash gap that goes along with that, because if you've got assets sitting on your balance sheet, they have to be financed somehow. Either it's third party, which is up in your debt obligations, and or it's yourself through the equity. It has to be financed someplace. So when we take a look at the key metrics, return on assets and return on equity, this is where this ratio can change significantly. If you're acquiring assets and building up your asset mix real quickly, you're probably going to have some tough situations on good cash flow. And I think that's where this cash flow budget comes into play, is that, hey, what are our terms on our acquisitions? A few best practices on improving operating results. We're going through it right now. We're in the off-season of our accounting practice. Our year-end was 5/31. We've got all our HR taken care of here. Basically now we are taking a look at our new employee hires. We're taking a look at the budget going forward, our expectations of what kind of revenue we're going to generate. We're taking a look at what staff needs. We're taking a look at the market, what HR is going to be looking for new salary hires, what our annual salary increases are going on. Obviously, that all factors into our price increases, what bad debts, what industry we were in, that maybe we didn't collect as many, all the revenue that we generated in there. Well, that's going to affect our price strategy here for the upcoming year, and again, it needs to be looked at. We talked about allocating resources in a capital expenditure budget. We talked about the labor incentives that you're looking to add on. Again, should be factored back into your cash flow budget for the year, so everybody knows where you're at. And number 4 here, I can't say it enough. You are fighting costs every day of your life. There's not a vendor out there who's not trying to increase their share of the market. There's not a vendor out there that's not trying to increase their own gross profit margin. So you need to fight cost structure daily. Part of that is your actual purchasing terms. Part of it is really along your project management. Part of it is certainly along your working capital management. Part of it is certainly the terms and the procedures you have in generating cash for your business. No question. With the opportunities in the marketplace after going through this 4-year downturn, tough cycles, I believe everybody feels that they're poised for growth. They've got a leaner machine, the opportunity, there is capacity in the organizations with the current labor force, the technology they have to really generate some additional revenues and bring that on board to increase cash. But again, it's about fighting your cost structure. And I made a comment about a good practice habit for those in the position you're in to put a weekly financial report or a monthly report, executive summary together for that ownership group. We talked about billings. Again, importance is about the documentation procedure, and certainly today there's a lot of software with automation procedures and meeting deadlines. Again, we can't forget about that, and I did talk about billing timely, and our example was 3 times in regard to the project at the end of the year to prepare a reviewed financial statement for a client. They may not like it, but we want to make sure that they're aware, hey, we are timely billing. It helps us manage our process and manage our staff more efficiently when we're doing that. Deposits, lots of different technology tools out there that you're probably being bombarded with in regard to ideas from your banking and financial partners, which is awesome. Regard to receivables, I think oftentimes I do see in organizations with rising inventory levels, they've probably not been quick enough to identify either the obsolete or the material that probably should have been returned by the allowance, the time period, 60 days. You bought it and you had 60 days to return it. Just don't have a practice habit in place to do that. No question. Now you've got the investment, and you're hoping that your salesman finds a customer out there who may want to be acquiring that, but that may be a long timeline versus, say, I had the 60 months, it didn't work out, and we end up returning it. So again, it's just a practice habit. What are you doing with these different items that are on your balance sheet? Do we have practice habits and policies and procedures for each asset on that financial statement? Security deposits, again, you want to make sure that the accounting person's tracking everything down. If you're renting locations, all of a sudden you've been out of them, did you apply a security deposit? Did you follow up on it when you changed terms or changed locations? Again, on the reverse, are we sure that the security deposits, do we have the discipline in our legal document to accept the security deposit and not return it unless all these demands are being met? Again, just a practice habit, maybe worth reviewing that with your legal advisor. The third item here is key. Everybody is taking a look. We're going through an exercise with a group action coach. It's called Traction. And in the Traction concept, there are 3 or 4 different boxes for each organization or each business unit to look after. One's the overall, one's the marketing, one's the operation, could be HR, one's the finance, collections, that type of thing. But one individual, only one name is in each of those 4 or 5 boxes for that respective unit. And the key part of that is because that individual has the responsibility for the accountability for getting those things done in that respective box. So again, back to item number 3, if you've got a process, have you identified one person to be responsible for it? If you've got 2 or 3 names in there, the likelihood of it happening is not very high. Again, I'm going to say, you've got one process, you need one accountable name there. That's when you're going to make sure, the organization's going to make sure that action is going to be executed on, because otherwise it get passed around. Receivables, obviously I mentioned before about factoring, not always attractive for a number of organizations, but certainly an opportunity. To talk a little bit about the cash process, and obviously separation of duties is very key. Segregation sometimes is very difficult to do in a small organization, but every once in a while the owner's just got to step in and say, do you want to sit down for 10 minutes and hey, give me the, he's never opened a bank statement before. He said maybe, hey, let's open a bank statement together and go through the checks together. Maybe that's enough of an impediment to make sure that the responsibilities are being handled accordingly. Cash forecast, we see, depending on the extent of the organization, can be certainly day-to-day or week-to-week at a minimum. I'm working with a $5 million subcontractor involved in the drywall painting trade, typically, therefore, kind of get in toward the end of projects and that. We're talking about the CFO starting to provide a weekly cash flow report with about 4 or 5 metrics on it, and we're going to meet with that organization weekly until we get this cash management program under control and everybody knows where we're at. And part of that is really assigning the responsibilities. Back to that other item, define one person in charge of that responsibility, that process. And we think, pretty confident we're going to have some great success. But again, depending on the organization, is going to depend on how often you have to make sure that you've got that practice habit in place. Again, timing of S&G, selling, general and administrative, SGA expenditures, is again back to that kind of talk about the ABC vendors. And finally, I'd like to emphasize again that cash possession worksheet is very, very powerful, and all organizations should be looking at putting something together like that for cash management. That kind of concludes my presentation, but I do want to make a couple comments. There's a tool out there now called Business Intelligence, and typically Business Intelligence is really an effort to glean the right kinds of information from your organization. It could be coming from HR, could be coming from operations, could be coming from sales, whatever. It's really a data warehouse in the middle of all these different activities going on in your organization. The importance about business intelligence is to pull the right data from these different areas of effort in your organization. The purpose of it is a select number of key financial ratios which are going to help improve your business operations and ultimately cash flow. And I think for those of you who have the responsibility to for the financials, the reporting, I think it's an area that probably should be investigated quite a bit, because every organization runs on data. Their issue is they want to make sure it's accurate data, no different than cash flow. If we're trying to determine, hey, are accounts receivable really 82 days? Is that what our turnover is? And the industry's at 54. We have some significant problems. Maybe your data is not as accurate as you feel it should be, and therefore that indicator is a little bit misleading. But again, I just bring it up because over the past 18 months, I've seen a lot of organizations turn to this business intelligence as an area, as an effort, as an initiative in your organization to improve cash flow. So it might be something of value.